Hey, it's Tom here and welcome back to the channel. So it's monthly Q&A video time yet again. So just last night I put a community post up here on YouTube asking for your questions for this particular video, and I'm going to start working through them. So we've got a lot of questions. I think the channel has kind of gotten to the point now where there's more questions on some of these Q&A videos than I can possibly get through in one reasonable length video. So I'm both kind of happy and sad about that. It's great to see the channel growing and I really appreciate all the support, but at the same time I apologize to sort of anyone's questions who I haven't been able to get to. So with all that said, let's just dive straight into this. I'm going to roll the camera for 20 or 30 minutes and just kind of see how many I can get through. So if you do want to ask a question in future Q&A videos, just keep an eye out for my community posts here on YouTube. You can turn your notifications on so you can see all of those community posts that I share. And then if you get in relatively quickly on some of those posts, you should be able to get a question featured in one of these Q&A videos. So let's jump straight into it and I hope you enjoy. Okay, so first question here is from Rajvardhan. What made you start a YouTube channel? Where do you live in New Zealand and how old are you? Sure, so I might answer those in reverse order. So I'm 26 years old. I live in Hamilton, New Zealand right now. And in terms of what made me start the YouTube channel, I was kind of maybe a year or so into my investing journey and had sort of started just to get into the deep sort of rabbit hole of Warren Buffett and at that time Phil Town and just trying to kind of build an investment philosophy. And New Zealand has a growing kind of share market or stock market community here, I would say, but it's still very, very small relative to things like real estate investing, for example. So in a lot of ways, YouTube was just kind of an outlet for me to share my own ideas as I was kind of, evolving at the time and just getting into this stuff and still continuing to evolve. So it was a way to share my ideas, also interact with kind of like-minded investors. And I've said it several times at this point, but it's pretty amazing how much just talking to a camera and trying to explain ideas kind of solidifies those concepts in your own head. So those are some of the reasons that I started the YouTube channel. I'd be lying if I said that I didn't see other people that have done it and sort of turned it into a reasonable kind of like side hustle, side business for themselves as well. So that's been an added benefit. It's certainly kind of getting more significant in that aspect of my financial life as well. So those are a couple of the reasons why I have started the YouTube channel. So thank you for your question. Next question is from Gabrielle. Tom, have you done any research on BYD, Build Your Dreams? So yeah, BYD is a Chinese electric vehicle maker. It's one of the largest, if not the largest investment, I think, of Li Lu at Himalaya Capital. So I've looked at it a little bit because I know that Berkshire Hathaway also owns it, and I know that the Daily Journal Corporation, which Charlie Munger sort of oversees, also owns BYD. But I think I'm probably a little late to the party on that one, to be honest. Like, I've seen the stock run up a lot, and I've seen Li Lu actually trimming his position in BYD and start to sell a little bit of it. So I don't know about you guys, but I do not want to be on the other side of a trade that Li Lu is making and kind of buying up those shares when he's selling them. So sort of as I've seen some of those things play out, it sort of had me less and less motivated to do any sort of deep dive on BYD. So I don't really have a lot of thoughts worth sharing on it, to be quite honest with you. So appreciate your question nonetheless. Next one is from Gumby Green Eye. How much you bench, bro? I think I've had this question in 2 or 3 Q&As at this point. So if you don't know, you probably noticed from like every second or third video I film just about, I have some sort of like New Zealand powerlifting shirt on. So I did compete in powerlifting for about 4 years. My best competition benchpress was 157.5 kilos. I'll maybe put a clip of that just here. And that bench press was done at New Zealand Powerlifting Nationals a couple of years ago on the under 105 kilo category. So bench press was never my best lift. I was probably a bit better at squatting and deadlifting. So best squat's 265 kilos, best deadlift is 280 kilos, and those are all in competition at the 105 kilo weight class. So yeah, that's where I'm at. Haven't been benching a lot recently. We've been in and out of lockdowns and stuff here in New Zealand, and actually been kind of switching over and been doing a little more strongman training. So been picking up like Atlas stones and stuff as well. Maybe I'll put a short clip of that here if you want to check that out as well. But really enjoy lifting up heavy objects for fun outside of YouTube and the day job and all that sort of stuff. So that keeps me entertained. So appreciate your question. Next one we have is from Kunal. Hey Tom, first of all, I would like to say you are doing great work. Thank you. I have two questions. Would be grateful if you can answer them both. I love investing stuff. This resonates with me a lot. I've studied a lot, and I'm actually studying, but whatever knowledge I've gathered is at a conceptual level. Can you please advise me how to actually apply them practically? Like, how do you go around an investment in an appropriate way? So yeah, it is kind of one thing to read at a high level sort of concepts about investing, and I would say some of like the laws of investing. So, a business or a stock is a piece of ownership in a real business, and your returns are going to be strongly linked to the results of the business and the price you pay. So those are sort of classic Ben Graham, Warren Buffett value investing kind of principles. It's one thing to, sort of understand those things conceptually, but then to try and apply it in the real world can be a bit of a different challenge. So I would say the best way to do that is just to work through different case studies of businesses and read about how smart investors are thinking about particular investments right now. So a really good resource for something like that would be the Value Investors Club. That is just some professional investors are probably in there under like aliases and stuff, but for the most part, it's just individual investors kind of pitching some of their best ideas, and they've got short, sort of concise write-ups on particular stocks that they're pitching at the time, and then you can start to get a feel for how they're sort of practically working through each of the different companies that they're analyzing. So I'd say checking out those sorts of things would be a good place to start, and then also just try to apply it to businesses that you already know. So if you're like an Apple customer, for example, or if you use some of the different Facebook platforms, if you're a customer of those businesses in your everyday life, you're probably going to understand their products and their business model fairly easily. So those would be sort of good starting points to kind of work through as well. And in terms of Kunal's second question is I have just started earning, and until I gather enough confidence to make bets on my own, I have decided that I would do systematic investment plan. So can you share points to look out for when selecting a plan? Thanks, Tom. Yeah, sure. So I can't really offer like personal financial advice or anything on this channel, but I can tell you what I do personally. So the only sort of systemized investment approach I have is what in New Zealand we have called Kiwisaver. I'm not sure if you're from New Zealand. Not sure, but in New Zealand we have Kiwisaver, which is basically our form of retirement account. So a percentage of my salary from my day job goes towards Kiwisaver, and there's really not a lot of flexibility to go out and like pick individual stocks like I do in my personal accounts. So that is a situation where I've kind of just chosen to go down the low cost indexing route, and the basic idea behind that is, I have a long time, presumably before I plan to retire. I can't actually access any money in my Kiwisaver until I A, buy a house, or B, reach 65 or whatever the retirement age is when I'm, in my 60s, if they maybe push it out a couple of years or whatever. So that investment account has a pretty long-term time horizon. I'm going through a little bit of a shorter-term investment approach in that account at the moment and being more conservative with it right now, because I do plan to use basically all of that money actually to buy my first home. But once I get over that hurdle, I'll be contributing again, and it'll be in more sort of growth mode. So there's two things I'm basically trying to achieve there. I'm trying to get the highest possible exposure I can to shares, to stock markets, because that's likely to have the best returns over the very long term. It's going to be a bumpy, more volatile ride than just being in bonds and things, but that's kind of the goal, is growth over the long term. And then I'm also, and I have no affiliation with this company whatsoever, but I also use Simplicity here in New Zealand, which is basically a non-profit. So they run their Kiwisaver accounts with as low a fees as humanly possible, and that is a very important aspect if you're going to go down the indexing sort of path as well. So, if you're in a fund that's charging like 1 or 2% fees, that can really, really eat into your long-term returns. So hopefully that gives you a couple of things to look at, yeah, thank you for your question. So next one is from Tim DL. Thanks for your videos, Tom. Thank you for watching. So my question, I'm a follower of Phil Town, and you obviously, thank you. I'm top skimming my wages and building my wash tub. Everything I see is way overpriced and being patient. I'm predominantly looking in the US, although I'm UK based, so maybe need to come closer to home. Are you doing the same? Are you waiting? And what are your strategies with the urge to either get caught up on the hype or not get disgruntled? Yeah, good question. So this is an interesting one. I learned a lot of my early investment kind of principles from Phil Town, and I think he is very much on the right track for the absolute beginner. I think you can sort of graduate to the Monish Pabrais and Buffetts of the world maybe after Phil Town. There's a couple of things that I think are a little oversimplified, kind of looking back at it now, but by and large, I really agree with a lot of Phil Town's principles. One of the things I don't necessarily agree with so much is that I would say Phil Town has sort of become slightly more macro-focused than I am. I know he says that if he finds an individual company that's undervalued, he will buy it regardless of sort of whole market conditions, but when you look at his fund and that sort of stuff, he's still holding a lot of cash, so presumably he's struggling to find things. I have found some stuff that's interesting, the past 6 months or a year, so I actually don't have a huge amount of cash sitting around at the moment besides like a house deposit, but that's a kind of separate thing. So yeah, it is just a matter of waiting, really. I did have a reasonable amount of cash going into something like a March 2020. I was able to buy some stuff, not as much as I want. Yeah, it's just a game of patience, and I think the strategy to stay patient might vary a little bit from person to person. I really like things like the Warren Buffett punch card analogy, where if you only have 20 punches in this punch card in your whole entire life, and every time you make a new investment, you have to punch out one of those holes, I think that's a pretty good strategy to use. So for me, I'm pretty comfortable if I can find 1 or 2 new stocks in an entire year, and that's kind of the way I approach it. So hopefully those sort of principles can help you out a little bit. So thanks for your question, Tim. Next one is from QE. Has Baba's government forced commitment spending made you less bullish? Yeah, so this is actually something we covered on the punch card investing stream just yesterday. So if you want to get thoughts from sort of the full crew on the punch card stream, definitely go and check out their episode we did most recently, which was on calculating intrinsic value. But more or less my view is that I don't think this was entirely unexpected. And if anyone doesn't know, Alibaba is basically also committed to donations that they'll make over the next, I think it's 5 years, totaling around $15 billion US. So quite a sizable amount of money. If you look at some of the history with Tencent, they made a similar move not all that long ago, so I don't think it was entirely unexpected. And I'm basically just viewing it like a higher tax rate, frankly. I think looking at it through that lens is probably the best way to go about these things. Yeah, we sort of mentioned yesterday that it's a little bit of like an asymmetric bet. If you can put sort of an amount of money towards kind of the greater good in China in exchange for not being, just ripped apart with regulation and that sort of thing by the Chinese Communist Party, the CCP, that's probably not a bad place to put money. So there'll be wide-ranging views on that, I'm sure, but that's kind of the way that I am currently thinking about it. So thanks for your question. Next one is from Bruco LA. Can you share your view on weighted average cost of capital versus required investor return? A video about this topic would be really interesting. Thank you, Tom. Yeah, so very interesting question. This is one where you'll find a lot of value investors really disagree with sort of the business school way of teaching required rate of return and hurdle rates and weighted average cost of capital and all that sort of thing. And this again actually is a topic we covered on Punch Card yesterday when we talked about calculating intrinsic value. So yeah, definitely jump over to the Punch Card investing channel and check that out if you want to see the full discussion on calculating intrinsic value. But more or less my view is to discount cash flows across any business at the same rate. And in business school valuation classes, that will be blasphemy. I take more of the Warren Buffett view that if I get cash from a commodity business, or if I get cash from Coca-Cola, or if I get cash from Apple, all of those dollars spend exactly the same. So all of those dollars are of the same value to me, and I'm not really willing to discount cash flows from each of those businesses at different rates because they're more volatile and have a higher beta and presumably more risky and sort of through the sort of academic lens. So I discount everything just at the same rate. I think the real risk, and again, this is just using Buffett's words and kind of his teachings, is the risk really comes from the certainty of those future cash flows. So if you have less confidence in the business producing the cash flows that you kind of hope it will, you probably shouldn't be investing in the business anyway, unless it's one of these like bonus propri, low risk, high uncertainty type bets. But that's really where the risk comes from. So if things are kind of in the too hard basket from what I think this business might earn in the future kind of perspective, just don't even look at it. And if you can understand a range of businesses, I basically discount their cash flows all at the same rate. So I'm not doing any sort of calculation on an appropriate discount rate to use with different businesses and different industries or anything like that. Okay, next question is from Sten Hemming. Do you have more perspective on JD? I don't really have a lot of new stuff to share on JD.com. It's definitely one I want to look more deeply into. Really, a lot of my time has just been spent looking at Alibaba, which is kind of time consuming enough for me at this point. But yeah, I guess Alibaba often gets labeled as like the Amazon of China, and the more that you learn about that business, the more you realize that that's really not true, particularly for their e-commerce business. It is a very different business model. But JD.com is more similar to the Amazon e-commerce model, where they basically just go out and try to own everything. They own many of the products, they own the warehousing facilities, and they own the logistics networks and everything. Whereas Alibaba, has in their Taobao platform, for example, they have everyday people just trying to make money, selling their own products on the Taobao platform, and they're not even collecting fees for that. They're actually selling advertising on those platforms. So it's a lot more of a capital light kind of model with Alibaba's e-commerce business. But yeah, JD is one I probably need to spend more time on and haven't done too much more work on it just yet. So definitely one for me to look at. So thanks for your question. Next one is from Kids Channel. Do you think valuing a particular company beforehand is better before doing the whole research on it? And if it is, it seems to have a good discount, then we can proceed further with the research. Otherwise, we can pass this idea and can jump on other. Yeah, so basically, do I value a company before I go and do a deep dive? I would like to say that I don't, but that would not be correct. I try if I'm honest in many cases to just look at some surface level numbers, and it's really about trying to dismiss companies as quickly as possible for the most part. So if something's not profitable and it's trading at some massive multiple of sales or something, let alone some multiple of earnings, then oftentimes I just pass on it. So if you want to consider that, valuation before doing a deep dive, then I guess that probably fits into that category. But the thing with valuation generally is that you're trying to project the future cash flows for a business and sort of discount those back. So in order to do a good job at that, you really do have to understand the company quite well and the different nuances with each business, and that will give you a much better feel for what those future cash flows are likely to be. So you can do some initial valuation work kind of before you do a deep dive, but it's certainly not going to be anywhere near as reliable, I suppose, if those things can be reliable, because we are sort of doing a little bit of crystal ball gazing, I guess, informed crystal ball gazing, hopefully, with projecting out future cash flows. But yeah, I think those valuations are a whole lot more meaningful after you've done a lot of work on the business. But yeah, you can certainly look at some surface level indicators before you spend more time on these things. So thank you for your question. Next one is from Henry Michael. Hi Tom, do you have an opinion on the future of iron ore and gold stocks? I have a couple whose financials are very sound, but I'm especially concerned about the drop in iron ore price recently. And thanks again for your videos, mate. Cheers. Yeah, and thanks, Henry. I know you've been watching the channel for a long time, so I appreciate the long time support. Yeah, I don't have an opinion on iron ore or gold stocks. Again, I keep shouting out punch card in this video, but yesterday on the valuation episode, we talked about commodity stocks generally and kind of our view on that. And kind of long story short, my view is that I really don't touch commodity type businesses at all unless they are one of these like, they're going to earn their market cap and earnings in the next 2 or 3 years, and we're fairly certain on that. And, it's just kind of beyond those next couple of years where the uncertainty really kicks in, but the risk isn't necessarily there. So I really don't have much of a view on that. If you can find some of these commodity companies that do have some sort of like arrangements with their customers where they've pre-sold a lot of the iron ore or gold in these cases, that can be interesting because you have more clarity on what the cash flows are likely to be. But yeah, outside of that, I'd just be speculating on what I think those prices are going to do. So yeah, only time I'm getting into commodities really is if I think I can... I think I have a very low chance of losing money, even if worst case scenario kind of plays out in terms of commodity prices, and that kind of can get interesting where there's next to no downside, but you potentially have a unknown, reasonably good upside. So that's kind of where I've come to with that whole sector. So thanks for the question. Next one is from Atale Soidamir. Apologies if I'm butchering your name. How much time do you spend on reading for your current or prospective investments? For example, do you have a system like you want to read a certain number of 10Ks in a week? How do you balance your day job, investments, reading, and other interests outside of all of this? So I would say researching new companies when I get busy is sort of the first thing that probably falls off my list, if I'm being quite honest. So the YouTube channel does take up a good amount of time. I work a 40-hour week and obviously try to train to sports and have a personal life and stuff outside of that as well. So the actual investment reading can go up and down pretty wildly, to be honest. Like, at the moment, I have kind of just got through a pretty deep dive on Alibaba, and I'm really just kind of getting back to general reading now. So like literally just this morning I've started this book, Good to Great by Jim Collins. I just recently finished Richer, Wiser, Happier, and there's some other books I'm trying to get through as well. So I'm sort of in just like a general reading phase at the moment, and I don't typically kind of start with the A's in terms of just working through every company. It's maybe something I should do a little bit more. I'm more someone that if I find something interesting that just pops up, whether it's super investors bought it, or I see a write-up get posted on Value Investors Club, or someone shares something interesting on Twitter that kind of catches my attention, I'm sort of more on the lookout for those sorts of things. And if I find something really interesting, I'll do sort of the initial look at it, like I was just talking about with the, if something's trading at some massive multiple of sales, I just dismiss it. I'll go through that kind of process and just try to eliminate stuff. And if it gets through those initial filters, I basically get rid of the general reading stuff and do a deep dive on that company. So it can really fluctuate pretty wildly week to week or month to month. So I don't know if I have the best answer for that question, because there really is no like structure when I'm trying to read 5-10Ks a week or anything like that. But really interesting question. I know it's probably something that'll vary a lot between different investors as well. Okay, let's maybe try and do 2 more questions and then we will wrap it up. So next one is from Timothy William. How much weight do you put on gross margin in your investment thesis? Yeah, good question. If you'd asked me that a year ago, I would have said the higher gross margin, the better, and basically no exceptions. But my perspective has changed on that quite a bit, particularly after reading Richer, Wiser, Happier and getting to understand Nick Sleep's investment in a business like Costco. So Costco is a business that has notoriously very low gross margins, and they also have very low net profit margins as well as a result. And yet Costco has been a phenomenal investment. So kind of what's going on there? How do we reconcile these things? And basically what I've come to is it's not necessarily about the absolute size of margins. Like it's often good indicator that a business is strong. If they're earning high gross margins and they have some sort of competitive advantage, and they've got pricing power and all those great things, and that's fantastic, don't get me wrong, but I think it's less about the absolute number when it comes to margins, and probably more about the stability of margins. So with Costco, sure, they've had very low margins, but they've been extremely consistent over a long period of time. That thing is just kind of running like a well-oiled machine, and it's created a lot of wealth for shareholders. So that is probably the more important aspect, and that's a fairly new, I guess, insight for me. Okay, and final question here is from Jerry with a 3VDW. I would love to hear your take on the recent A2 Milk results. Thanks. Great podcast, by the way. Yeah, thank you. I've been putting more effort into the podcast. Still probably prioritizing YouTube, or definitely prioritizing YouTube, but thank you for the support on the podcast also. So, yeah, A2 Milk, it continues to be a really interesting one to follow. So, A2 Milk, if you don't already know, is like or at least used to be like a stock market darling here in New Zealand. It had like crazy good returns for the last sort of decade, and it's now down, I think, more than 70% from its peak maybe a year or 18 months ago. So it's been a really interesting one to follow. I have bought a sort of small shareholding in A2 Milk. It's my smallest position in my portfolio, but I sort of started adding to A2 Milk as it kind of got crazy with the amount of the just sheer reduction in share price and the massive amount of negativity, which is sort of very quickly turned up after like ridiculous amounts of positivity for the A2 Milk company. It's crazy how share prices and narrative are often very strongly linked, I guess. So, yeah, A2 Milk recently came out with their annual results, and the annual results were terrible. They were actually still profitable, but their net profit was down substantially. I don't remember the exact numbers off the top of my head, but I'll put a screenshot up here. And it was terrible, and the share price is down a lot, but it was within their guidance. So management had come out and said, we're going to have a bad year. They actually downgraded their guidance several times, and this was the first time in a while that they've actually been within their guidance range, actually. So I guess it was good to see them hit guidance. Obviously not great that they have had some, a rough year or two at this point. But these are the kind of things that potentially create opportunity, right? So I guess in terms of the actual financials, within guidance, so tick that box. The big thing that's going on with A2 Milk at the moment is they are trying to get the sort of freshness and average age of their inventory improved. So they have had some major problems with that, and that's caused big inventory write-downs, and A2 Milk just flat out destroying a lot of their sort of infant formula inventory as well to try and basically sort that issue out and avoid having to like sell products at not profitable, very low prices and potentially damage the brand. And from what I can gather from the recent results from A2, that process seems to be on track, which I think is promising. On the day that the results were announced, I think A2 stock went down a further like 8 or 10%. I think if I had to speculate a little bit, it's probably the fact that A2 Milk didn't offer any guidance that has caused that to happen in the market. Yeah, stock markets really don't like uncertainty. So A2 Milk typically gives guidance quite often. So to see them just give no guidance because things are so uncertain at the moment was quite interesting. And I think that kind of continued to scare a lot of people off. I guess on the positive side for A2, they did hit their guidance numbers. They are cleaning up that inventory from what I can tell. And they also have like an extremely rock solid balance sheet. I don't think that's something that gets enough attention for A2, is they have no debt, they have bucket loads of cash, and they can weather some pretty serious storms. So it's going to continue to be an interesting one to follow. Like I say, I've got a shareholding, but it is not my highest conviction and my sort of idea in my portfolio, that is for sure. But those are kind of some thoughts on the recent results. So that's all we have time for this video. Thank you to everyone who asked a question. I apologize if you did ask one and I didn't get a chance to get to that. I try to do these about once a month, so definitely keep your notifications on for community posts that I put up where I kind of collect these questions, and like I say, if you're in there quick, you should be able to get one in for the next video. But that's it from me. I do hope you enjoyed it. If you did, please hit like and also hit subscribe. Like I've been saying a few times now in recent videos, we're giving away a copy of Poor Charlie's Almanac back here at 30,000 subscribers, and we're not too far away from that milestone now. So really appreciate the support, and I will see you in the next video. Cheers.